Okay, so how and why can we use this to trade off of, right? These areas of supply and demand. So all right, so what is the difference between a supply and demand zone and an order block? So they're quite similar, right? There's a lot of similarities, or they can occur in the same place, I should say, but there are differences, right? So basically, for those of you who are unaware, okay, an order block, right, is let's say that we've got liquidity generation. Okay, so whether that's, you know, something like this, right, where we've got lows that are being respected, okay, the market starts to move up, people start buying and then place stop losses under here. So we've got liquidity, market comes back down, respects it again, right, even more people get involved, start buying the market up, put stop losses below. We start to generate liquidity below these levels, okay, and basically all I mean by liquidity is resting orders, right? As we know, if we want to get long in this market, we need people on the opposite side of our order. Now, I'm sure most of you are aware of this, but just for the people who aren't, again, we need people on the opposite side of our order to fulfill our orders, right? So if we want to buy in this market, we need someone who is willing to sell, okay? And vice versa, right? If we want to sell, we need someone who's willing to buy, okay? So liquidity gets formed in the market, right? And market makers or bigger players in the market will sell into this liquidity to then take up their buy positions, okay? Because they understand that there's a high volume of orders down here, right? So that is what an order block is. So let's say from this point, right, we want to buy, and we're a big institution, right, a big hedge fund. We want to sell down into this liquidity to then take the market higher, right? This sell down to then buy is what we call an order block. So this move here would be our order block. So what is a demand zone? Now we could also look at this area as an area of demand, right? So let's just back up a minute, okay? Let me explain what supply and demand actually is. Okay, so in the UK, I'm sure a lot of you, I don't know what it was like for the rest of the world, but we had a fuel shortage, right? So there was a point where everyone was queuing up to get fuel because we had we had a fuel shortage, right? There was a low supply, in fuel, right? So what happened, right? We had people that were queuing up for fuel, right? So we had all these people that were queuing up for fuel. But the trouble is we had a limited supply, okay? We had a limited supply of fuel and we had a load of demand for it. So what happens in this scenario, right? Low supply of fuel, high demand. Prices start rising, okay? There's not enough to go around, so the prices start rising, right? And obviously the fuel companies have to produce more and more fuel to keep up with the demand, right? So then what happens? The fuel companies start making more fuel or start distributing more fuel to all the stations, right? And eventually the supply meets the demand, okay? The supply meets the demand and we start to balance out. So as the fuel prices start to balance out, everybody who once wanted fuel has now got fuel, right? Be it at an inflated price, because that's what happens. Obviously, if there's a load of people that want something and there's only a limited amount, you know, the price goes up because someone will think, well, I'll pay you $1, or I'll pay you, you know, $1.10. I'll pay you $1.25, right? I'll pay you $1.30 because they all want it. When the supply meets the demand or starts to outweigh the demand, we start to consolidate, right? And then when the demand or when the supply outweighs the demand, the price starts to drop, okay? And it starts to drop because all of a sudden we've got loads of fuel and everyone's got their fuel now, right? Less and less people want it, so the price reverts back, okay? And that is essentially the same in any market, right? I hope that, I hope that sort of made sense. And it's the same with currencies, right, or any other asset, okay? Obviously, there's a lot of people down here that want to buy this asset, right? So as people are buying the asset, right, the price starts to rise. And as people are exiting out of their positions, right, and they start to sell the asset and there's more supply than demand, the asset price will drop. So what is the difference between going back to our point, right, what is the difference between an order block and a supply and demand zone? Well, obviously, like I said, an order block is a capture of liquidity. So again, we understand we've got liquidity through there. An order block is a capture of that liquidity in order to buy. Okay, and a demand zone is an area in which the amount of buyers in the case of demand will outweigh the sellers, right? Or the rate at which people want to buy the asset or currency or the oil, whatever it is, outweighs the pace at which the sellers want to sell it, and the price rises. Okay, so how can we? And a lot of the time, right, if you guys aren't familiar with Wyckoff, this is the whole premise of Wyckoff, okay? And generally what you'll find is that the supply zones are areas of accumulation, right? Where the price drops, the banks and institutions accumulate their positions, okay? The demand in the market outweighs the supply and the price rises. Okay, this is our markdown phase, right? In Wyckoff, this is our accumulation phase. This is our markup phase, right? And as the supply meets the demand, we start to consolidate. People take profits, and potentially start to short, right? The supply outweighs the demand, and we mark down. Okay. Now so this whole area here, just to clarify, right? This area before the markdown would be a supply zone. This would be our area of demand, right? And again, you can refine these further for trading, right, and build specific rules around your supply and demand zones, in order to make them tradable, right? Now, just to clarify, an order block will generally appear in an area of distribution or accumulation, okay? Which is why people often confuse the two and they think that they're the same. They generally can, well, not generally, they can happen in the same place, right? Not every area of supply is going to have an order block in it, right? Not every distribution area is necessarily going to have an order block in it, right? You can have springs in an area of distribution, but not necessarily a run on liquidity and an order block. Okay, an order block, again, like I say, is a run on liquidity. An area of distribution or an area of supply is the transfer from buyers and sellers, right? So people that are, retail traders here, they send this markup, they want to get long, so they start buying, right? But smart money is selling, right? They see this rally up, they're buying, smart money is selling. Right, they're buying, smart money is selling. Okay, this is the transfer of supply and demand, right? The demand outweighs the supply, and we start to mark down. Okay, again, the same is true on the opposite side, right? All right, so how and why can we use these areas of supply or demand to trade off of, right? So obviously, generally the premise is, in fact, let me delete this to see if we can find some live examples, right? So we've got, let's just pull this on, we've got an impulsive move, right? An impulsive move. Large impulsive move, right? Oh, an impulsive move, an impulsive move, an impulsive move. Okay, an impulsive move, right? Impulsive move, just bear with me. An impulsive move, an impulsive, what am I doing? an impulsive move, an impulsive move, an impulsive move. So these are just like really obvious areas, right, where I've seen price react from. Okay, so down here you can see that price is reacting from this level, right? Through here we've got some impulsive moves. You can see price is reacting from this level, right? Same here. Price is reacting from this level. Got some impulsive moves through there, right? Same there. Okay, if we'll just do the extremes. Okay, so how and why can we use this to trade off of, right? These areas of supply and demand. So again, if we was to drop down into a lower time frame, this is an obvious sign of accumulation, right? The market moves down, we start to bottom out, we consolidate, right? The area of consolidation, so let's just show you like consolidation before the markup, right? We push up, an area of consolidation before we mark down, okay? And again, this could be argued that we've got an area of consolidation before we start to mark up, right? Same here. Area of consolidation, so we get the markup phase, the area of consolidation before we retrace. Price returns to this level, we see a reaction, right? We mark down, consolidate, accumulate orders, we start to mark up. As we come back down, similar sort of thing happens. Obviously, you know, this isn't every time the market consolidates, it isn't necessarily going to be an area of supply or demand. So how and why can we trade it? So there is many different reasons why price may or may not react off of a supply and demand zone. Now, a lot of the time it is because there is still liquidity, either in the form of pending orders, so like orders that were unfilled that are still down here, you know, order blocks, which again is a form of liquidity, or imbalances, again another form of liquidity. Basically the market is just coming down here to fill orders, right? Long story short, the market is coming down here to fill orders. That's one reason. The other reason is because either a bank or an institution values the asset at this price. Maybe they're building out, you know, obviously we understand the market's fractal, right? We're looking at this on a 1 hour time frame. This move here, even though this is Wyckoff, right? This whole move here may be part of a bigger accumulation schematic, right? So they might be coming, so price is moving down, the bank or institution builds their position, the supply outweighs the demand, the market rises, right? Comes back down, they do the same thing, okay? And they're just building out their position, generating more liquidity to potentially fill the rest of their orders, and then take price higher on a much higher time frame. Maybe if we was to move out to the daily time frame, right? We can see that area, let's just delete some of that area that looked like, you know, like these little areas here, just this little pin bar, this little area, obviously we understand that there's Wyckoff accumulation all the way through there, right? Building out liquidity to then run price and take price higher, right? So just a reaccumulation schematic as part of, if we was to move out to the weekly or even monthly, a higher time frame accumulation, right? So that's one reason, right? Basically, a market or an asset is going to hit or trade off of a supply and demand zone because of liquidity, right? Either people are interested in buying the asset at that price, or there's resting orders still there that the market comes back down to mitigate, right? Basically, long story short, it's liquidity, right? That's why the market reacts off of it. So how can we trade it? All right, so how can we trade it? So this isn't a strategy video. This is just to explain, really just to explain the difference between an order block and supply and demand zones, right? Obviously, you guys know what order blocks are. We've explained that. You know what supply and demand zones are. How can we identify them? How can we use them? So back on the pound yen, right? We can see that this asset dropped from this price point, right? When the price was at this consolidating area, okay. So obviously we had a markup, right? We had a transfer of orders, right? Had a transfer of orders in this area, and then the demand outweighed the supply, or supply outweighed the demand, and we dropped off. Okay, so let's say that we're looking at this area here. Obviously, we don't know that this is going to happen, before it happens, right? Obviously, if we was looking at this here, we have no idea that we're going to be able to short here, right? We don't know that yet. We need to wait for it to play out. Okay, so we're moving higher. Again, you could argue that the supply or the demand outweighed the supply, and we rose higher here. Okay, and again here the supply outweighed the demand and we dropped off, right? Where do we come to? We come back to this level, right? Straight away we see a reaction. Why? Because there's resting orders, imbalances, liquidity, interest at this level. Okay, so price then reacts off of this demand zone, right? Travels up to supply zone, messes around there for a little bit, taps into it a couple of times. Again, similar sort of thing could be argued, right? The generation or the transfer of liquidity, right? So this is where this is the difference between an order block and a supply zone, right? This area is a supply zone. This is an order block, right? We've got liquidity generation through here. Where are we? Always lose that, right? We've got liquidity generation through here, liquidity generation under here. We've got to buy up into the liquidity, sharp sell through, move up to then mitigate again on a lower time frame. This is the whole market is fractal, right? Every single financial market that you will be trading is fractal. If we was to look down on a 1 minute time frame, again, this is just going to be a move up and then a transfer, right, of orders. Okay, your accumulation, right, your demand supply zone, distribution, sorry, right, you know what I mean. Okay, it's a move up and a transfer of orders, right, from retail wanting to keep this, on a shorter time frame. This is moving up. Everyone's getting happy. We're flying, right? The market's flying. Let's buy. Yeah, smart money selling. Retail buying. Smart money is selling, right? And as soon as that transfer is complete and the demand outweighs the supply, everybody gets liquidated. Okay, all these stops get hit, the market moves even faster, we drop into another mitigation area, we come up, take liquidity from the top side, and the cycle continues, right? Now, the danger is, right, when you start to think that you look at this and you think, right, I'm going to buy here, okay, right in the middle of my demand zone, and then I'm going to shoot for targets right up here for no apparent reason. Yeah, not necessarily a bad trade, right? Not necessarily a bad trade. But the trouble comes when you don't appreciate that, again, the market's fractal, right? Because like I said, right, this on a 1 hour is a demand zone. Okay, but on the when we start moving out to higher time frames, it starts to become pretty irrelevant, right? So don't be surprised if we see a liquidation of that level and a move all the way down to a different level. Again, an area of high liquidity on a higher time frame. Take them take the liquidity from that level, and then we move higher, right? I hope that sort of makes sense. Obviously, how can we tell? You can't always tell, right? You know, people like to think they can. You can make educated guesses and good judgments based on your interpretation and understanding of how and why markets move, but you're never gonna catch every zone, right? I've done a video on this about order blocks, right? You're never gonna catch every order block. You don't need to catch every order block. You don't need to catch every supply zone, every demand zone. Okay, obviously, you know, a lot of you know that trading is about you know, developing your understanding of a specific way of trading, building out specific rules of engagement into a strategy, back testing that strategy until you have a proven edge, and then, you know, going through a process of forward testing that in, you know, demo, just to prove to yourself that you can execute under live conditions. And if you're happy at risk capital at your own risk, right? Again, you know, none of this is financial advice, so I shouldn't have to say it, but I'm gonna say it anyway, right? Anyway, got on a bit of a tangent there, right? So we move up. Okay, let's just delete this. Right, we drop through. We hit our supply zone, right? Tap into that, and we drop, right? Oh, that's where we are now. Okay. So what was I explaining? Right, I was going through areas of supply and demand and how we can trade it. Right. Okay. I'm sure, you know, I think that was a good enough explanation. Right. I'm sure that I hope anyway that was a good enough explanation so that you understand the difference between areas of supply and demand and order blocks. If it isn't, let me know and I'll do another video. But I'm going to keep this one short and sweet. I hope that you understand. I hope you got value from the video. If you did, be sure to hit the like button and subscribe to the channel. And wherever you are on your trading journey, I hope you have a good week, and I'll see you on the next one.